Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Markets, and I'm Sonali Basak, and it's time now for the Wall Street Beat. Stock-picking hedge funds are coming back into favor for the first time in 2 years after a turnaround in performance, and so are multi-strategy managers. Some of them are really having better times now. Schonfeld Advisors was actually the best-performing large multi-strategy hedge fund in the first quarter, and in the quant world, multiple AQR funds saw double-digit returns so far this year. And we're going to get a gauge of the whole industry with Ilana Weinstein. She's the founder and CEO of IDW Group, which finds talent in the hedge fund space, and you always have your ears so close to the ground. Really curious about what you're hearing now that we have all the numbers in for the first quarter on what's working this year.
Let's do a what's hot Richter scale. How about that? Multi-managers continue to be an area of desire and focus. Particularly, of course, goes without saying, the large established managers like Citadel and Point72. But, those guys are either closed or being extremely deliberate about how they take in capital. So you mentioned Schonfeld. I was pleased to see they're actually leading the pack this year. We'll see how the year shakes out, because the last 2 years were tough. And I think that's the result of the guys who were accepting capital, because on the back of poor long-short equity performance in 21 and 22, capital flowed, would be an understatement, avalanched into the multi-managers that were accepting capital, and these guys grew between 3 and 8x. So they kind of, I think, had a challenge in absorbing that much capital and in hiring truly great talent in a very short time period to deploy it. The other strategy that you mentioned, long-short equities, is doing phenomenally well in precisely the funds that had a tough time in 21 and 22. So hot, but I think be careful you don't get burnt, because as we saw, those funds tend to employ a go big or go home strategy when it comes to concentration, nets, subsector tilt, and it will be interesting to see when the tide turns, which inevitably it will, and we've seen stocks turn before fundamentals do, and they'll need to be able to respond to that so that they don't get caught sideways the way that they did then. So proceed with caution on that.
Yeah, really curious about that, because how long does a fund have to really be performing well before it could start to attract top talent again? How well do these strategies have to do before they're really in vogue for people to flock to those managers?
I think what talent wants is consistency of returns. It's not a win big, lose big, but rather a fund that can really put up the goods year in and year out. And there are very few funds that have been able to do that. And it really goes to building an ecosystem that makes the people that they hire, this is a really important point, better by virtue of sitting on the platform. So it's investment in systems, risk, technology, and continually evolving that. It's looking at who their top analysts and PMs are and looking across for best practices, and then using that to incorporate making people better and moving them along the experience curve such that they are the best version of themselves. They are constantly taking a good hard look of how they're winning, not resting on their laurels, and incorporating those lessons in terms of making the firm better. Sonali, it's everything, every aspect of what they do.
So you're talking about a lot of investment that funds have to make in order to bring fresh people on. And of course, you are your people, right? We know that in this world. But what are you seeing in terms of how competitive it is out there in this environment? People are starting to bounce back. How easy is it for them to bring new people on? Or hard, rather?
Again, I think it comes back to two questions that talent asks the smartest people in the industry. By the way, when we say talent, I want to be really clear. It's often euphemistic with people. There aren't that many truly talented people. That's been true always. And I think the best people in this industry ask themselves two questions when they're making a move. The first, and it may surprise you, I'm not going to even mention compensation here. The first is, will I be better by virtue of making this move developmentally? Will I be the best version of myself? And the second question is there more opportunity at this place that I'm going to relative to where I'm at? Or is it an easier path in order for me to achieve what I want, i.e. not much of a headwind? And because at the end of the day, compensation, the guarantee is a year or two, and then you're out, and you really need, and then you're on your own, so to speak, and you need to put up the goods. And the question becomes, are you really set up for success? How do you develop? And what are the resources the firm has to get you there?
Well, one big kind of controversial question these days is pass-through fees, right? It's been more of a question for investors, and I'm wondering, with or without them, how do the top talents really view that? If you don't have them, is it worth going over?
Pass-through fees are a double-edged sword, okay? Part of the Met performance we saw in a number of these multi-managers that took in so much capital and grew so quickly is they hired all these people. That raises their expenses, which also raises the bar for what the return has to be, right? So if you can't perform, or it's not a sustainable ecosystem. And talent recognizes that. Pass-through fees certainly help, but there are more and more funds every day that have a pass-through structure. What they're looking for is sustainability, and that this is a place that will consistently win, not sort of have some good years and some not so good years, and also really prioritizes development from within. It is really compelling that Citadel can say that 2/3 of its PMs started as analysts or associates, okay? What that means is they are manufacturing their own alpha makers. And that's how you get out of this merry-go-round of everyone hiring from everyone else, because you're developing people from within, and when someone leaves, you have someone sitting there that you really know what they're capable of to move along.
Ilana, we only have about a minute left here. What are you watching as we enter the second quarter? Books are closed on Q1. What's next?
Okay, so in addition to multi-manager performance and long-short equities, I am so excited about credit. I continue to think it's an incredible growth story. I knew there was enormous activity last year, but it may surprise you to learn $150 billion went into credit alone, and there were 20% more funds in this strategy in 23 versus 22. And I think the market opportunity is only increasing as defaults increase. We know banks haven't been able to put risk on their balance sheet, and so there's share for the taking.
We'll have to have you back soon to talk just about that movement. It's an interesting time in fixed income, certainly in liquid markets. Ilana Weinstein, founder and CEO of IDW Group, we thank you.